Welcome back to another episode of the Backholder Pod. So recently, the SPY has hit an all-time high of more than 500 points. In translation, the SPX is more than 5,000 now. So I think just to kickstart the entire discussion, there's always two group of investors that are playing the tug of war. On one hand, there's one group that says that, after going up so high, it will definitely retrace back downwards, which essentially is the mean reversion theory. On the other hand, there's another group of investors that say that you should ride on the momentum. The all-time high will continue breaking through. So I think to extend this entire discussion, I'll get maybe Kelvin to talk about what do you think is the game plan moving forward? Should we continue buying in this market?
Actually, yesterday I've just bought another 10 QQQ on the 2% S&P 500 retracement. Okay, technically I'm buying at all-time high. But this is the strategy for dollar cost average, right? You buy at all-time high, you buy at all-time low, and the market keeps going up over the long term. I guess the bigger question is like, will the S&P 500 crash back down like 10-20% this year in the short term lah. So the first thing is the S&P 500 is overvalued when you compare it to the past 25 years. So they are looking at forward 12-month PE ratio. It's overvalued lah, but I would say it's not as overvalued as back then in 2000, like in 2020. So it's now around 20. Still, I think it's still okay lah. Then the second thing is like the reason it's going up is because companies expected earnings for this year and the next few years are also expected to go up. So this increase in the S&P is just reflecting this kind of thing lah. So, but if it goes up while the expected earnings goes down, then something is wrong lah. But for now, I think it's actually still not too overvalued.
I realize a lot of people like to draw PE comparisons, and I think there's like CAPE ratio and a lot of all the different valuation metric, right? Just wanted to ask Bunti, how do you see this whole trying to value the S&P 500 and your take on it now? On the same note, you can share the NAV of your portfolio. So I think it's at all-time high recently.
NAV. NAV 没事没事. Okay, come back to this. I think this one, I saw, I think Kelvin also shared before, right? Like using all these indicators to show that whether market is overvalued or not. So I think first thing I want to stress is that usually when people looking at stock market, because if it is at all-time high, it's very clear, right? You see that it is like at the peak, right? But all-time high doesn't mean it's overvalued. So you need to look at the market and look at something else to cross-check. Usually people look at PE is because how much you paid should tie to the earnings power of the index or of the companies, right? So I think this one coming from current market valuations, I think I've seen this before, quite interesting.
Hey guys, gather around. I've got some fantastic news to share.
What's the scoop? You have another stock that 10x?
No, it's something even better than that. You can get to enjoy free shares.
Huh? How?
Oh, I've heard of it as well. Huyams, one of the top brokerage firms in the region, is now offering a new account opening exclusive fund and trade rewards. They're offering 0 US commission for 90 days, 0% sales charge on unit trust, and guess what? You might even score free JD and Alibaba shares when you open a new account and meet certain criteria.
Wow, free shares. Sounds good. What do I need to do?
So it's actually pretty straightforward. So if you make an initial deposit of at least 3,000 Singapore dollars within 14 days of opening your account and execute at least 3 buy trades on stocks, ETFs, or unit trusts within 90 days, you'll get 2 JD shares. Now, if you go for the higher tier, deposit at least 10,000 Singapore dollars and execute 5 buy trades, you'll enjoy 2 JD and 2 Alibaba shares. So that's free shares worth up to 280 Singapore dollars.
Nice. But what about those of us who want to park our money in short-term investments like money market fund?
Great question. For those interested in short-term instruments like money market funds, Priyams has something called Smart Park. It's essentially an asset fund management facility that invests and manages your idle cash automatically. And the rates updated as of 5th February is a 7-day annualized yield of 3.72% on your SGD.
Sounds like a really good deal. How long do we have to take advantage of this?
Don't wait too long. This opportunity is only until 29th of Feb 2024. So, if you want to double your happiness and prosperity with Poems, act now and don't miss out.
And you see, it's not just like one metrics, right? PE is one of the metrics, which is the second one here. This is PE. And then besides that, they also have others. For example, Buffett indicator. This is measuring between the GDP versus the stock market. It is also at overvalue, not like at all-time high. Like you can see that there are periods that even it is higher. And then you look at PE also, currently it is on the high side, but not as high as during the dot-com bubbles, but definitely overvalued. This one very interesting. This one is interest rate model. Basically, what people are saying is that yes, it looks expensive now if you look at PE, but bond market is also very expensive, meaning that the interest rate compared to historical is still very low. So if your alternative is going for like bond market, right? If the bond market is expensive, then it makes sense for the stock market to be expensive as well. So this is like a comparison between the bond market versus the stock market, and it is fairly valued. I think this is the only one that shows that it is fairly valued. And then the other one, which is looking at the mean reversion, it is like close to all-time high, but not really like like super high compared to the past bubble like during 2000. There are a few more which I don't think is that important. Like there's one that talk about margin, I think also quite interesting. This one is looking at if there's a margin debt at all-time high, right? Like that there's huge margin, meaning that people are borrowing money to invest in stock market, right? So it means that it means that market is like not to say overvalued, right? It's like very bullish, and usually it will follow by some corrections. But let's say if you go back to end of 2022, you notice that actually this one is very high, very low, because people are liquidated, right? I think those who borrow money and just use leverage to long the market, they will get like stop out because market dropped so much, right? So I think this one, all in all, I think talking about whether market is overvalued or not, you have to look at various metrics. But right now, it seems that yes, market is on the overvalued side now.
So if we make the conclusion, or you agree that the market is slightly or in the overvalued range, right? So what's the game plan moving forward? Continue buying or hold dry powder, or wait for it to retrace or for it to crash?
Depends on how much dry powder that you have, right? Because for example, right, you say, oh, market is overvalued now. I have 500,000 all into T-bill, wait for market crash. Then let's say after 6 months or 9 months, market still at the same level or even let's say 5% higher, then your T-bill at 2% or 1.5%. So initially your T-bill earning, let's say let's say 3.7% looks high, right? But we don't know whether that 3.7% will stay for how long, right? Let's say it crashed down to 1%, 0.5%, then you are earning nothing. You are waiting for market crash but didn't crash, then now your cash earn nothing. That's also a situation that I think very bad for those who didn't take risk at all. And worse is that let's say market going up even more, so you cannot buy at even higher level, right? So you're stuck there. If you start for 3-5 years later, market is like 100% higher than today's level, right? So what do? Do you stop investing for your whole life? So I think that's a risk of not investing enough. But let's say if your cash is only like, let's say, less than 20%, right? I think just continue DCA as long as you are not like 120% leverage. I think should be fine. Just long the market for a long period of time now, and compound the money.
Eric, your thoughts on the valuation of S&P 500 today?
I think it's pretty high. I'm not very sure whether it's my thoughts like tinted by the last time we were in a wild bull, and then I got into Tesla, and then the PE expansion was like going up like crazy, and then like PE of 100 is considered normal, and then it just keep expanding. Then people think that, oh, PE 250 very normal for growth stock, like because you will grow like 200% a year. So it's within 4 years you come back to PE 50, something like that. So the reasoning is when on a bull market, right, the PE will always be expanding because your earnings are going up. But people will take it and extrapolate all the way. As we know, market move in cycles, so it's not gonna expand all the way. So I don't know. I got a question for Bunti also, like since 2 months ago, like will Nvidia keep going up
okay, earnings coming soon, right? So whether it continue to quite big or crash back down depends on the earnings. But it seems that from today's valuation, a lot has been priced in, and I don't think these are justified valuations. I think mostly these are traders, those momentum traders. They keep riding on the momentums, right? So that's why share price going up and down. Sometimes it detached from the intrinsic value. I think that's quite normal.
Hey guys, gather around. I've got some fantastic news to share.
What's the scoop? You have another stock that 10x?
No, it's something even better than that. You can get to enjoy free shares.
Huh? How?
Oh, I've heard of it as well. Huyams, one of the top brokerage firms in the region, is now offering a new account opening exclusive fund and trade rewards. They're offering 0 US commission for 90 days, 0% sales charge on unit trust, and guess what? You might even score free JD and Alibaba shares when you open a new account and meet certain criteria.
Wow, free shares. Sounds good, huh? What do I need to do?
So it's actually pretty straightforward. So if you make an initial deposit of at least 3,000 Singapore dollars within 14 days of opening your account and execute at least 3 buy trades on stocks, ETFs or unit trusts within 90 days, you'll get 2 JD shares. Now, if you go for the higher tier, deposit at least 10,000 Singapore dollars and execute 5 buy trades, you'll enjoy 2 JD and 2 Alibaba shares. So that's free shares worth up to 280 Singapore dollars.
Nice. But what about those of us who want to park our money in short-term investments like money market fund?
Great question. For those interested in short-term instruments like money market funds, Huyams has something called Smart Park. It's essentially an asset fund management facility that invests and manages your idle cash automatically. And the rates updated as of 5th February is a 7-day annualized yield of 3.72% on your SGD.
Sounds like a really good deal. How long do we have to take advantage of this?
Don't wait too long. This opportunity is only until 29th of Feb 2024. So, if you want to double your happiness and prosperity with poems, act now and don't miss out.
But if you say, okay, it is overvalued now, let's short the stock now. You see, if you do these kind of things, then suddenly they announce their operating income double again from last quarter, then what do, right? So I think that's something that even if the share price deviate a lot from the intrinsic value, right? And by intrinsic value, I mean valuations that include all your expectation. Even if it detach, it doesn't mean that we can profit from there, because to take advantage on these overvaluations is like you have to take a lot of risk. So I don't think it makes sense to short companies like Nvidia. And you just need to stay away if you are not invested. That's fine.
Just wanted to follow up a little bit from the video I think we made quite a few months ago. Remember we were going through Nvidia's earnings and things like that, and then you talk about the data centers, and I remember I asked you going forward, right, the next few quarters, do you see the data center, the revenue going up still? And then I think, if I don't remember wrongly, at that time you say that yes, it's projected to be strongly increasing for the next 2 to 3 quarters at least.
Yeah. 2 to 3 quarters, I think that's quite clear because there's so much demand and there's limited supply, and that's why there's this they have pricing power, right? When it's so scarce that you can basically price it at any price, people will still buy, right? Because limited is very small. And still this year they are still at expansion in terms of the productions of all the computers, all the data center machines, right? So I think this year definitely still increase just to increase the production to meet the demand. But next year or the year after, who knows, right?
Okay, I think maybe I don't want to make you predict the future, but the other time where you were saying it, right, that was maybe 2 quarters plus ago.
Yeah.
For the earnings review. So now the outlook is still, you're still projecting 2-3 quarters is still pretty clear that it's going to expand.
Yeah. Expand, confirm. Expand how much cannot confirm. Because it might be, they could be still expanding at, let's say, quarter over quarter, right? Let's say 5% or 10%, right? It's still expansion, but maybe market will tank already because you can't project, let's say, like a 30% growth rate when they just grow by 5% a quarter, right? So at some point it will slow down, definitely. It won't go up like moon every quarter for the next 8 quarters. Definitely won't happen. But the thing is, how long can it go also is something that we don't know, right? How big is the market? You can look at, like, for example, maybe you can ask Chicken also, right? Like if you read the transcript of all these customers, right? For example, like AWS, Amazon, or Azure, Microsoft, or Meta, right? How much all these H100 they bought, right? So they're spending billions and billions of money. I don't think they can keep ramping up this kind of spending for every quarters, because it will eventually larger than their total revenue if it keep going like this for a few years, right? So I think there's a limit on how much they are able to buy. Chicken, any comment on Meta spending on all this H100?
No, good lah. Continue buying lah. Buy as many as they can. I mean, it's part of their capex cycle anyway. So I think the logic is, that's why I think on my own end, I think Nvidia's earnings, I'm not sure how sustainable it is, or at least I can't project out. So for myself, I haven't caught that AI wave or that chip wave, specifically for the designers. So that's why I'm not touching it lah. Even though the story is very exciting. But I think coming back to the valuation and buying S&P 500 and being at all-time highs, right? So if now let's apply this logic to stocks, I think out of the four of us, Bunti is the only one that has the best exposure, right, to the stock that keeps going up, right? I think intuitively, we always have that urge, right? When we hold a stock that keeps going up and up and up, right? Number one, you scared that it's too overvalued and then retrace back downwards. So they say that, oh, the fruits have already ripened, but you never take out the fruits, then it become rotten. I mean, that's one way of describing that scenario. Then on the other hand, there's some that I still recall fondly. I think when Meta was actually doubled from 100 to 200, right? A lot of people start picking the fruits. Then from 200, they proceed to 400, meaning they 2x, meaning they 4x from their bottom lah. So there's this two school of thoughts that are basically contending each other. On one hand, you're scared you don't take profits, the thing drop back down. On the other hand, you take profits already, double again. So it's always, I guess it's a difference in time horizon. One might be thinking about trying to realize quickly, while on the other, he wants to compound the money. I think the biggest worry really is on the other hand, which is where you see some stocks, right? Maybe they climb for like 5 years, 8 years, it goes up and up and up. And then another 3 years later, it come back down to IPO price. So there's always this contention. And I just wanted to really understand, let's say Bunti now, right? When I'm not too sure what you do with your Nvidia position now, but are you playing around what you have now, or selling options on it, or whatever you're doing?
I think the difference between these two mindset that you just mentioned, right? I think one key thing is also the allocations, right? So for example, right, there are people like you know, they look for catalysts, let's say like 1 year, 2 years catalyst, right? And then they will just place some positions. And when they place a position, it's not like a small positions. It's like it's kind of outsized relative to how much capital that they have. They could be using call options to leverage up, or they could be, you know, like just put on, let's say like 40%, 50%, or even 80% into one company to ride on certain trend. And if it started out with like very outsized positions, right? So if they hit it right, and then market just like go up, let's say for example 3x, 4x, right? Then it will become like so big that if they just cash out, it'll be fine. Like they already, you know, like benefited from this wave. So I think that is one way to invest, is that you look for catalysts, and then you just ride on short-term trend, and then just hope for all these like short-term whatnot, right? But there are people who are like me, like I don't even have a big position to start up, and every companies that I want to place, right? Maybe I place like, you know, like let's call it like 3%, 5%, and then just let it ride, right? So from 3%, even if it, let's say like 3x or 4x, is only at 10 to 12%. So if I keep on in and out between these 3 to, let's say, 10%, right? Actually, the money that I can earn, right, is at most, let's call it like 10,000, 20,000. It's not going to be, you know, like life-changing kind of money, right? So there's no point to in and out if you started out with very small positions lah. But that's one way to do it, right? It's like I don't want to, you know, like burden myself from in and out, like keep looking for all these catalysts. To me, it's just like long-term hold. And then I'm not betting on Nvidia more, like not increasing my stake now, but I can always put my money in other other companies, right? For example, as of now, let's say if I compare the Magnificent Seven, right, I still think Apple is a company that's getting interesting, given that they just came up with Apple Vision Pro, right? I think their magic still intact, you know. So if I want to, bet on companies, I would like to increase my exposure in some other companies, and not Nvidia as of current, given the valuation.
If you got itchy fingers, just learn more strategies. So you don't have selling the stock is just one of the strategy, ma. And if you're wrong, then you miss the boat already. Don't it keep going up like what happened to Meta? If you sell at when break even, you have GG already. So look at other strategies lah. Options is one of them. Actually, options is a lot of them. So yeah.
Can I just ask a quick question to Wunti? Can you help me to explain this part? Because I'm a bit lost. So I was just looking at the charts for Nvidia, right? And I noticed that this PE chart, right, there was a spike up last year, mid of last year. You see the topmost chart, right? There was a very big spike up. But if you look at the revenue, or maybe am I looking at the wrong thing?
PE, you should look at earnings.
Should look at.
Earning crashed to like almost zero.
So
I don't
it's
remember.
because of the earnings chart actually crashed like in last year, right? Then that's why the PE spike up.
Yep.
But why did the earnings crash so much, even though the revenue just dipped by a little bit?
Yeah. I think back then the data center, all these all these H100, they haven't really ramped up, right? So still quite a huge proportion of their business are those GPU that sold to the gamers. And I think this is also related to crypto. I think there's, everything crashed, right? Like one year each ago. Everything crashed, including all the cryptos, and then even all these GPU also crash in terms of their resale price. So I think it hurts their business quite badly, meaning that they keep mentioning during the earnings call is that they have a lot of inventory. They just want to clear up the inventory. I think they even talked to TSMC to reduce production to manage the inventory. This entire semicon how to say recession, right, actually happened even as of now, right? We are still in a semicon recession. It's just that now it's like close to the bottom. Everyone is talking about recovery, when it will recover, how steep it will recover. But we have been in this recession for quite some time now, about 1 year, plus minus lah. So during that period, really their earnings dropped a lot lah. They are not to the extent of like losing a lot of money, but still it dropped a lot compared to their peak earnings before that.
Yeah. What I'm just curious is, as investors, right, how do we take advantage of this seemingly seems like a cyclical thing, right? Like
Yeah.
they have this glut of inventory that
Yep.
they want to clear, and then just before, like, you see, within half a year, it become the poster boy of Wall Street, like, could we
Yeah.
have predicted that based on the slump? Were they positioning for something versus another company that there's a slump in their earnings, and then we thought, oh, recovery play, reversion to mean, and then after that they keep slumping all the way. So I find it very difficult to identify which company does it fall into. That's why there's a lot of pitfall, I feel. So
Yeah,
I just wanted to get.
semicon always cyclical. That's the things. But even the overall market also you can describe it as cyclical. I'll show you this. So you see this one, right, is the S&P 500 annualized return, but it is not like every year return. It is a 10-year rolling stock market returns. So it's like 100 plus years of historical numbers. But how they break down is that, like S&P 500 returns, right? You can break down into different components. So let's say every year you just receive dividends, right? So dividend will be a source of returns to you. Even if the index is like totally flat and you still receive, let's say, like 3% dividend, you will get 3% returns, right? So this is the dividend part, the brown color one. And then there's a earnings growth part, meaning that price equals to PE times the earnings, right? So the earnings growth will also be a source of your returns. And then aside from these two, right, it will be like change of the valuation. Earnings could be, like constant, but let's say if you buy at PE, let's say 10, you sell at PE 20, then you double your capital already, right? Or let's say you buy at 20 and then sell at 10, then you lose 50%. So the green and red is the change of the valuations. So you can see that even the entire markets, right, even at a 10-year rolling kind of returns, you can see that it is still cyclical because let's say if you have to cash out, let's say you invest for 10 years and you cash out around the 2007, 2008, right? You will lose money, you see, you lose money from the PE contraction because PE really dropped a lot. But you could still offset by others because earnings growth, dividends are still there. So there will be period where you see the PE is very, very cyclical one. So there's a period where PE contract, PE expand, PE contract and expand. But the one that is more sustainable, right, is actually the earning per share growth. So you look at the blue bar here. It's like even if PE don't change, right, if you hold it for like decades and decades, right, you're actually betting on the earning per share growth, the blue one plus the dividend yield because if the companies don't pay out the dividends, they use the dividend to do share buyback. And if you do share buyback, your share count will decrease, right? So that can boost up your EPS as well. So I think these two should be added together. If you hold it for long term, you are betting on this blue plus the brown. But let's say if you say, oh no, I think that market is overvalued now, I want to short the market, and then maybe market crash, I cash out already. Then you are playing with the predicting where's the red and green, right? So it's just like different game. I think that chart is I find it quite interesting is that you can see that sometimes we can be betting on like the earnings, which you get it, EPS, you get the dividend, but sometimes you're just unlucky and you didn't enjoy the P expansion. Let's say if PE just contract, then your result won't be as good now. But
I
as
think
long as
one of the consideration after looking at your chart, right, is that the green bar seems like to be getting more and more sustained period compared to the PE
that's a
contraction.
bit of recency bias lah. Yeah.
Recency, like past 50 years, 60.
No, recency bias as in you look at past 10 to 15 years, there's more green than red because market generally, PE generally goes up.
No, I was looking at your chart, the one that you showed just now only. From 1979, the green bar seems like it lasted a very, very long time. Like you see from 1979, right? There was this bit of the red chunk. If you look from left to right,
Yeah.
100 years ago, like
That's
it
right.
was quite evenly, but then out that 1980s onwards, right? You see a very long period and then a very short period of red bar from the
Yeah.
great financial crisis, and then out that you see that the green bar looks like it's taking over again.
Yeah.
But I think
Those, right?
one consideration might be, right, because of we factor in the real value of money,
No, I
like
think
including
mainly it's because during this period, interest rate has been going down. Like interest rate has been going down for like 40 years, right? So except for the recent 1 year, right? When inflation skyrocket. Before that, interest rate keep going down, meaning that the entire bond market has been getting more and more pricey. And stock market also consistently going up together with bond market. Everything up, right? So everyone what? So good. That's
what
why
in a
everyone has
sense,
been promoting S&P 500.
but what in a sense that the amount of thing you can get with the same dollar actually decreased quite a bit, right? During this.
Yeah, that's right.
Yeah. So you devalue the dollar, but the stock market return looks pretty. Is that the conclusion that we can get?
I think it's dangerous though to think that the cycle will get shorter and shorter. Meaning you look at like what Bunti said, right? Because there is only four cycles of expansion and contraction. Even though you say that it's 100-year horizon, but I'm sure the S&P actually goes back even further than 100 years. So it then comes to the point where is the low interest rate a given, meaning we are all addicted to low interest rates and the Fed will accommodate and then will push us all back down to 0%, or how is it going to move forward? This I don't know. So I think it's hard to draw an extrapolation from here. But that said, I think it's true that for the general advice of buying S&P 500, it has been working for the last 30, 40 years. And Presumably, so people will presume that it will continue working for the next 30 to 40 years lah. But to at least for me, my short answer is I don't know.
Only CPF will work for the next 30 to 40 years.
I think there's this quote that Bunti likes to share. I think this one Bunti said one, not I say one. He said, "Those who feel certainty are stupid." So I guess that's my ending to this discussion.
That's not my quote.
Not your quote.
Okay.
Then that time you say to me, right, or something. Whose quote was that? I think I also maybe just one last pointer, right? I think this video a bit long already, but I've seen some conversations and I wanted to ask Kelvin about this as well. So we know the SPY now is at all-time high, near all-time high, it's at 5,000 points, or the SPX lah, the S&P 500 is at 5,000 points. Then some people say that, okay, so from here, I'm gonna anchor. I'm gonna whack 1 times good ones when it go down 10%. So it's at 4,500 points, I'll whack 1 times, like if it retraces down by 10%. But then I went to track back, right? I actually went to see, actually 4,500 points, not too long ago leh. So in August of 2021, it's at 4,500 points. It was during the peak bubblish period, right? Where everybody said that, wow, crypto to the moon, high growth stocks to the moon, everything to the moon. Then they say that we were in a everything bubble territory. Then after that, from 4,005, 4,006, it crashed back down to like 3,000, 3,005. And then now it retraced back up to 5,000 points. So we already broke all-time high. Then now if you retrace back 4,500, it's back to the bubblish territory. So it makes me wonder, actually, this anchoring effect is very interesting. Like how people think about just 2.5 years ago, they said that everything is a bubble. Then now at 5,000 points, if it goes back down to the previous bubble territory, I'm gonna buy. So yeah, I just wanted to hear Calvin's perspective on this. Was there really anything that systemically changed in the last 2.5 years?
I think it was just the interest rates going down, inflation going down. Everything was resolving itself from the pandemic and the Russia-Ukraine war, right? So now it seems like all the bad things are gone. And because of that, the market has started going back up lah. Maybe because of there's no bad things now, it's no longer in a bubble territory. Maybe they will stay true for a while. Because right now there's this whole AI revolution going on, right? I think last week Google released their, or more like they renamed their Bard into Gemini, something like that. So, and Apple, I'm suspecting they are going to come up with something on their own also lah. Like what Adam Khoo says, the next revolution, what is that called? The sixth revolution, something like that is here. The next wave is here, which I think will be very, very true lah. So yeah, just ride the wave, lor. Don't try to time it, lor. Then as to just now Eric mentioned about that 1980s, why did the S&P 500 started going back up? Then Bundy gave the interest rate thing. I think the other thing is because of the easy money printing lah. So the US left the Bretton Woods Agreement, which is the US dollar tied to gold, whatever thing. They left it around that time also. That's when the US started to have easy access to a lot of money lah. And that's what boosts the stock market together along with the low interest rates. But that will have a kickback effect. So now a lot of other countries, emerging countries, are trying to escape from the US dollar by forming their own currency, reserve currency, that sort of thing. They're trying to trade in other currencies. They call it what? Petro yuan, something like that lah. So it's one example of it. The BRICS, BRICA, BRICS currency, they're also coming out with their own reserve currency. So I think this points to a trend that the US market will not last forever, because other countries may come out with their own thing, with their own technology, come out with their own alliance, and I think it will eventually overtake US lah. As to when, maybe not in the next 50 years lah. Maybe it'll be a bit longer than that lah, because right now the US reserve currency is still about like 60%, and no other currency is big enough to overtake it lah. No, I think the countries don't trust each other enough yet lah. It will last for a while more lah. That's my prediction. This whole S&P is the king kind of market to go to.
Right. I think maybe just to round up this entire discussion, just my own personal concluding thoughts, right? We should always try not to anchor to price, but anchor to something that matter. And in this case, it's always the earnings. So if the index is supported by good earnings and great growth, I do see it continue running. However, if like the bigger question on why people are skeptical is really on the sustainability of the earnings. So because of this kind of AI wave now, It might be a one-time pump, it might be a continuous pump. So that's the worry about trying to time in and out, test your theses and your theories. What if you're wrong? Will you miss out everything? And if you're wrong about it being sustainable, then you buy in and then you whack at all-time high, then that's when it retraces back downwards again. So of course, the conventional wisdom is always to ask you to stay invested, dollar cost average, and to continue participating in the market returns. So I guess that's just generally my thoughts. Don't try to anchor that, oh, now it's at 5,000, retrace 10%, 4,500, I'm going to enter. What if it doesn't retrace to 4,500? What if 4,600, then it bounce back again? Then you'll be like, oh yeah, then I wait for the next all-time high and then retrace 10% again. I think that's not really how we should look at things lah. So I think that's just generally it. Any concluding thoughts from the rest? If not, we'll see you guys in the next video. Goodbye.